In January 2023, the world watched in real time as more than $100 billion in market value seemed to evaporate almost overnight. At the center of it all was one man, Gautam Adani, and the vast business empire he controlled, the Adani Group. For years, Adani had been praised as the symbol of India's economic rise. A college dropout from a modest family in Gujarat who supposedly beat the odds and built an empire of ports, power plants, airports, and mines. At his peak, he was worth more than $90 billion on paper. For a brief moment, he was richer than Warren Buffett and almost every tech billionaire on the planet. Then, on January 24th, 2023, a small American firm called Hindenburg Research pressed publish on a report with a brutal headline. It accused Adani of orchestrating, quote, the largest con in corporate history. Within days, shares of Adani companies crashed. Over $100 billion in value was wiped out, and the world started asking a simple but chilling question. Had one of the fastest-growing business empires on Earth been built on lies? To understand why this hit so hard, we need to look at the scale of what Adani claimed to have built. The story starts in the 1980s, when Gautam Adani moved to Mumbai and got into the plastics trade. From there, he expanded into commodity trading, then ports, then power, then coal mining, then airports. By the early 2000s, the Adani Group had become one of India's most important infrastructure players. Today, Adani's ports reportedly handle more than 40% of India's container traffic. His companies run crucial coal mines that feed power stations across the country. His power business supplies electricity to millions of homes. His group controls airports that together handle tens of millions of passengers a year. On paper, it looked like the perfect story for investors. Infrastructure plus a fast-growing emerging market, plus a politically connected founder who seemed to always be on the right side of government policy. Between 2015 and 2022, some Adani companies saw their stock prices rise more than 20-fold. But when you look under the hood, something immediately feels off. Companies that operate ports and power plants usually trade at fairly modest valuations. Their profits grow steadily, not explosively. Yet by late 2022, Adani Enterprises was trading at price-to-earnings ratios above 200 times. Many of his listed companies were trading at more than 100 times earnings. For context, boring, regulated utilities around the world often trade between 10 and 20 times earnings. Even fast-growing tech stocks in their prime usually sit somewhere between 30 and 60. So how did these very ordinary, capital-intensive businesses end up priced like hyper-growth tech unicorns? That is the first mystery in the Adani story. Hindenburg Research claimed it had the answer. After a 2-year investigation, they alleged that the Adani Group had engaged in a decades-long pattern of stock manipulation and accounting fraud. According to them, the soaring share prices were not a reflection of genuine investor demand. They were the result of a carefully constructed feedback loop built through dozens of offshore shell companies. Let's break down how that allegedly worked in simple terms. Imagine you own a company and you want its stock price to go higher. One way is to make more profit. The other, easier way, is to create artificial demand for your own shares. The Hindenburg report alleged that Adani did exactly that, using a maze of entities in places like Mauritius, the United Arab Emirates, and Cyprus. These offshore entities were supposedly independent foreign investors. In reality, Hindenburg claimed many of them were secretly controlled by people closely linked to the Adani family. They allegedly bought large quantities of Adani shares and rarely sold them. When a stock has a big buyer who never seems to sell, the price tends to rise. Other investors see the price going up, they assume something good is happening, and they jump in too. Rising prices then make it easier for the company to borrow money from banks, because their shares can be used as collateral. This creates a powerful loop. Higher share prices make it easier to borrow. Borrowed money helps fund more projects or acquisitions. That activity is then used as a narrative to justify even higher share prices. Meanwhile, offshore entities keep quietly soaking up shares to keep the price supported. According to Hindenburg, this was not some small side operation. They claimed to have identified 38 shell companies linked to Adani interests, many with almost no visible business activity beyond trading Adani stocks and bonds. Now, why does this matter beyond the stock chart? Because share prices in Adani's world were not just vanity metrics. They were part of the capital engine. As prices went up, Adani companies issued more shares and took on more debt. By 2022, the group had accumulated more than $30 billion in debt. A lot of that debt was secured against the very shares that offshore entities were helping to inflate. This is where the structure becomes fragile. If prices fall sharply, the value of the collateral collapses. Lenders can demand more collateral or repayment. If the company can't provide it, the whole illusion can unravel very quickly. The Hindenburg report didn't just focus on stock price manipulation. It also raised questions about Adani's reported revenues and profits. It alleged that certain offshore trading partners were being used to round-trip transactions. In other words, Adani companies could buy from and sell to related parties at manipulated prices, creating the appearance of higher revenue and profits than a truly independent market would support. If true, that would mean that not only the stock price, but also parts of the income statement and balance sheet were distorted. The Adani Group, for its part, denied all allegations. They called the report malicious, politically motivated, and an attack on India itself. They argued that all transactions complied with the law and that their offshore investors were legitimate independent entities. But markets are not courts. They don't wait for verdicts. They react to fear. Within 24 hours of the Hindenburg report's release, Adani companies began to plunge on the stock exchange. Within a week, some shares were down more than 50%. At one point, the group had lost over $110 billion in combined market value. Gautam Adani's personal net worth dropped by tens of billions. An ambitious share sale that was supposed to raise billions of dollars from new investors had to be abruptly canceled. Banks that had previously been happy to lend against Adani shares quietly stopped accepting them as collateral. Credit rating agencies started to ask hard questions. And yet, something strange happened at the same time. Major Indian banks that had lent heavily to Adani insisted that their loans were safe. The Indian government downplayed the crisis. Regulators announced investigations, but moved slowly. For a while, the message from powerful institutions was basically, nothing to see here. This brings us to the second mystery in the Adani story. How did so many analysts, bankers, and regulators look at valuations that extreme, debt levels that high, and ownership structures that murky, and still decide everything was fine? Part of the answer is simple incentives. Indian banks had billions of dollars tied up in Adani projects. If they raised alarms, they risked triggering exactly the kind of panic that could make their own loans go bad. So instead of asking, "Is this safe?" many quietly chose to believe it was. Another part is politics. Adani was seen as closely aligned with the Indian government's infrastructure push. Questioning Adani's numbers started to look, in some circles, like questioning India's growth story itself. That's a powerful social pressure to stay silent. And then there's the third part. When a stock keeps going up year after year, it punishes skeptics and rewards believers. Over time, the market doesn't just stop asking hard questions. It starts attacking anyone who does. The lesson of Adani is not just about one man or one group. It is about how modern markets reward silence, encourage herd thinking, and punish people who ask hard questions. The next Adani may not be in India. It may not involve ports or coal or airports at all, but it will almost certainly follow the same script. Rapid growth, opaque structures, rising debt, and a long line of very smart people who decide that it is safer not to know too much. If you want more stories of how fortunes were built and empires fell hit, subscribe, turn on notifications, and join me as we uncover the next financial mystery before it explodes in the headlines.